Hi everyone, this is Syed Jaffer and I'm a real estate professional in Hawaii. Today's video is about mortgage calculations and comparing payments based on different interest rates. If you are in the market to purchase real estate and you are thinking should you buy real estate based on current mortgage rates or should you wait for a year or longer, hoping that mortgage rates may go down, I will show you that comparison in today's video. So let's start. Let's start with some key terms which will be used in this video. Property value, or also called as purchase price. The price you are offering to a seller to buy a real estate. Down payment. This is the amount of money you will be putting down from your pocket in a real estate transaction. In our calculations, we will use 20% down payment. Loan amount, or principal, is the amount of money that a buyer is borrowing from a lender. It is the difference between the purchase price minus down payment. Term refers to the number of years that will take to pay off the loan. Common terms are 30 years and 15 years. Mortgage payment is the total amount that is paid on a monthly basis. Total interest refers to the sum of all interest paid by borrower to a lender. Amortization schedule refers to a chart or matrix that shows how much payment a borrower will be making over the period of the loan. This includes principal and interest payments. On this screen, you are looking at loan calculation, and there are three different loans as you can see. The property value is $850,000 for all the three loans. Down payment is 20%. And the loan amount is the same for all these three different loans. What's different is the interest rate. The first one, loan 1, is 7%, loan 2 is 6%, and loan 3 is 5%. As of today, in October 2022, the average mortgage interest is about 7%. And let's say you are a buyer and you are considering should you buy at 7% or should you wait for a year or longer. If the mortgage rates will go down to, for instance, 6% or 5%, then you can see the difference that on the screen. So the mortgage payment is about $45.24 for 7%, $4,077 for 6%, and $3,650 if the interest rate is 5%. On this screen, I'm adding two more rows. First is the total interest and the difference. So the total interest refers to the sum of all interest paid by borrower over the full term of the loan. So in our case, we are using 30 years. So in 30 years, borrower is paying about $949,000 in interest. Same borrower will pay $788,000 if the interest rate is 6% and $634,000 if the interest rate is 5%. So the difference between 6% and 7%, just the interest, is about $161,000 and another $153,000 if the interest rate is 5%. So if you're a buyer and you are looking at these calculations in your mind, if you want to wait for 1 or 2 years, assuming that the mortgage rates may go down, which there is a possibility, however, it's not guaranteed or certainty that they will, then you can save about $300,000 over for interest payment over the entire period of the loan. On this screen, I'm adding three more rows that provide more information about interest paid. This is all the interest that will be paid over 2 years, 3 years, and 5 years period. I'm using 2 and 3 years as it is expected that interest rates may come down over the next couple of years. Market watchers are suggesting that if US economy goes into recession in 2023 or 2024, mortgage rates will be coming down to mid 5% range. On this page, you are looking at two different amortization schedules. On the left is for 7% and on the right is for 5%. We already saw in previous screens that the sum of interest paid at 7% is much higher. Another aspect is the amount of years that will borrower take to break even on payment between interest and principal? You can see that it will take about 20 years for 7% mortgage rate to break even, and it will take about 16 years for 5% mortgage rates. Thank you for watching this presentation. Thank you for watching this presentation, and if you like this type of content, please subscribe to my channel. Aloha.